Good afternoon. This is Ken Long of Tortoise Capital with a review of the weekend trading report for January 5th, 2018. Market is in bullish normal conditions. On an annual basis, looking at weekly RSI 14, we are still overbought at 87 out of 100. On a shorter term 10-day basis, using the 10-day NDX, we're also overbought at 98 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is green bullish at 9.85%, and the slope of the 50 is improved to 0.59%, also green bullish. ADX is a strong 27.7 bulls in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. The current reading is at 1.028, which is risk on. We take that score, look at the last 5,000 trading days for context, and compute the risk Z, which is how many standard deviations above or below the long-term average that reading is. It's reading right now at 0.21, so slightly above the long-term average in terms of lower volatility. So this is a 90-day histogram of that indicator. When it is above the zero line, that's favorable for owning riskier assets. The upward steps are a favorable sign. Right now we're at 0.21, so there's plenty of room for this to grow like it did before. This was a brilliant time to be in swing trades. This is a time to be, when it starts declining, is a time to be careful and protective about starting new positions and preserving your gains. When it goes below the zero line and is declining, that's a time to be emphasizing short positions. When it starts to roll over and move up, this is like the springtime planting, a time to take measured positions on the leading swing candidates. That's what we had, a nice little move in here, and this resumption is actually a favorable sign because you have a low, a higher low, and a third higher low, and so this is potentially very favorable. The blended monthly rebalancing holdings for January you can see, and then these are the winners based on the closing prices on Friday, and then some winners in the other categories of symbol populations. In ETF2, the theoretical exposure is 100%. This is the blended monthly rebalancing portfolios, taking a look at the performances of the 13 and 32 ETF portfolios. Notice the Dow, Tech, and Japan are in the lead right now. Emerging markets have been recovering nicely. Only treasuries and U.S. real estate are on cash positions, meaning that they are below their 4-month moving average. In ETF 32, again, most of the indexes are above long-term fair value. It's really only the defensive plays and the alternative asset classes like treasuries, real estate, short bonds, agriculture, and utilities are in the red. U.S. technology and XLK and the Qs are doing pretty well. The sector spiders are looking at 31 subsets of the U.S. markets, being led by metals and mining, oil and gas, home builders, then tech. So there's some real power inside here. I like looking for things that are in the green on long term and then either green or red on the 1 week and 1 month. And my reasoning is that these long-term relative strength leaders have moments when they can gain additional momentum, as you see semis and oil and gas starting to do, or they may have pulled back sharply and are now offering a buying quality on sale. So from these extreme conditions come extreme results. So I'll be taking a look at these sectors as priorities for developing new positions. On the other end of the scale, things that have been beaten down for long periods of time can show starts of recovering. So we might be looking at healthcare in that sense. It's been red on blended in the 6-month, but then the 3-month is only in the yellow, and then it's actually been above the database average there on 1 month and 1 week. So it could be that healthcare is offering some opportunities, or healthcare services, I should say. And you'll notice also that regular healthcare was in the white on 1 week. So it may be time to start looking at some of those positions, and in the large cap companies in the Dow that are in those sectors as relative strength leaders. ETF Max looks at about 500 different ETFs and then finds the ones that are the most liquid, and then looks at performance ranked by the blended percentage. It's a combination of 3 and 6 months. And again, I'm looking for greens here, and then I look for additional momentum, perhaps in small cap in India, and then maybe a rebound play here in pure beta nickel. This was in the green the previous week, so this is an example of something that had been dominant and then was maybe overheated and then suffered. Now, if you think nickel still has some room to go, then the fact that it's in the green is good, and then this sharp pullback means there's an opportunity to buy nickel on sale. So that's a trade framing that we might be interested in. Easier things to see in terms of continuous momentum. I would be least surprised if things that were green across the board and which turned in a green 1 week percentage. It wouldn't surprise me to see things like global metals and mining, India, coal ETF in China, China Tech, for example, all leading the way with additional momentum. So it is from extreme conditions that extreme results occur. So those are candidates for positions. In the market health check, the vertical blue lines are 10, 20, 30, 40, 50, 60 days of look back. The horizontal red lines are support levels that used to be resistance levels but which have held. And if price collapses from here, then these are the price targets that I look at on the way down and where I expect to see hesitation and support and recovery, much as it did here last time. You can see that we've had an amazing week. Found support at 267, has moved to 273. That was good enough that the slope of the 30-period regression line, which is marked by this sine wave looking curve, has moved and rolled over and started to hook back up. It got as high as 0.44 in this 30-day segment, which was an exceptionally good move, and it's continuing to resume. It didn't even flirt with failure much here. So that black dot reflects that this is starting to roll up. It's already basically at nosebleed. So this is an engine that is running at high RPMs. No signs of overheating yet, although in the press there's a lot of calls for that, I think, from folks who have hedged against it and are looking to get their payoffs, but we'll see. So the slope of the river, that's the red 30-period Bollinger Band, is uniformly up. The 30-period regression channel, the black line is up. The 10 has now begun to exceed the 30, so it's up. We're overbought. The jaws of PPO have opened to the upside, well above the zero line, so that favors long-term gains as well. It's all systems go. I'm looking at relative strength leaders and managing stops. ETF2, now all 10 of the sectors are back on buy signals. It puts us in an improved posture to 100% invest in 0% cash in the broad allocation strategy. The S&P at 43 is better than EFA at 40 under the strength column, so the U.S. is dominating the globals. Among the U.S. indices, the strongest are tech at 49, then large caps at 43, the mid caps at 40, and only the small caps are lagging in the yellow here at 35. Two strongest sectors are the Qs, and I'm going to say U.S. large caps for one more week until we see how the emerging markets do. And then the two weakest sectors, European 350 and U.S. small caps. Inside the 9 U.S. sector spiders, technology leading the way, along with energy and consumer discretionary. The 3 weak ones are the traditional defensive plays of staples, utilities, and healthcare, although I've seen some evidence that the healthcare might just be ready to start improving as we looked at BMR. World market model, the U.S. is split between above and below average, basically large caps to small caps. Asia is a mixed bag, but China, Singapore, South Korea leading the way, only India really suffering. I like the fact that we saw some green performances on 1 week and 1 month in India, and you combine that with the long-term pain that's been there, this may be a sign of India turning it around at the end of a long decline, and there may be some longer-term value positions being placed there. Europe is in the yellow, Sweden suffering, but only Austria really dominating. ETF top 30 using that ETF2 lens. Again, I'm looking for green on strength and white on consistency to look at things that were above average that are now beginning to dominate. The ones that are green across the board have been dominating, and they may be fully vested already. And so I look for signs of emerging growth from front runners, maybe the next stage of momentum. So metals and mining, oil and gas, Chile. Whereas things that are white and green, like South Korea, may be already starting to give back some of their initial momentum. Consistency is the 10-week average of strength, and so that's how you read that. The quality score is a reflection of the 40-week system quality number. So home construction has just been dominating, as has been technology XOK. Just liquidity for your references. Shifting to the daily. No signals in the channeling and overreaction. Very few mechanical signals firing. In fact, one. The auto framer, these are ones that test out well on the trade location with price compared to the 10-day high. And you can see the ones that were bottom of the stack, like the VIX and real estate and utilities, are the ones that are the furthest from their 10-day high. Intel may be able to survive that bad news about the chip weaknesses and so or malfunctions. So it may be an overreaction type of a play on the max pain side. So I'll be looking at Intel. Intel. Yeah, it even had some gains here on Friday. Boeing is probably of interest from a momentum play. It's been outperforming the entire Dow in every time frame, as has Caterpillar. Travelers test out at 2.9 to 1 on the auto framer and as a channeling signal. ETF 30, about the same thing, only these defensive plays testing out better than 2 to 1 on the auto framer. Utilities may be a play. Pinch and stretch. At first column, the most positive Z stretches. These are the ones that are the highest percentage and Z score numbers above their 30-period Bollinger Band. So these are the big positive stretches. These are negative stretches below the Bollinger Band mean. The expanded pinch boxes are the symbols that have the widest rivers based on 30 days of directional performance. Utilities is wide river, but as we can see, it's stretching below that the Bollinger Band mean. And then the most compressed pinch boxes are the ones that are postured for that Z3 compression breakout. And Apple is especially useful here with not only the river is very narrow, but all 4 of the regression lines have pinched very tightly. And so it's postured for a significant breakout in either direction. Stats on the auto framer, regression line fractals, the ones in the green. Top shelf here are the ones that are deep value plays that are the most numbers of ATR below their long-term fair value. So Merck, Coke, McDonald's. The ones in the red are the ones that are perhaps overheated, the most numbers of ATR above their own RL270. So IBM, you can see, is more than 10 ATR above long-term fair value. Let's take a look at that one. Okay, so here's an example. IBM is 10 ATRs above its long-term fair values. This is on a daily. So this is the RL270. And you can see here that the 270 is down here, but price is well above it. So that's 10 ATRs. And if we take a look at this as like a giant yin-yang, you can see that this cross has come up and started to resume and went higher. We're into this position from the green line. And the fact that it's getting ready to break out above this previous swing high, and there's a gap to close that goes all the way up here to 171. So IBM to 171 looks really attractive. It looks like it has already turned the corner from this big sell-off from 185 to 140, and so now this is that value play. I like that the jaws of the MACD histogram have opened to the upside, and it's above the 0 line, so this is a very favorable position, and I like IBM on the long side. Now, if we compare that, let's take a look at Caterpillar. That's just been an amazing story as well. That's 8 1/4 ATRs above its long-term fair value. This is what it looks like at the other end. So rather than a yin-yang, this has been a grinding gain that has continued to accelerate and still shows signs of continuing to go. If we took a look at this on a weekly basis, no end in sight. Here's monthly. So let's take a look at weekly. You can see this has just been an amazing run, and more to follow. What's going to stop it? Why wouldn't you want to own that? Home Depot. Oops, excuse me. So let's take a look at these ones that are well below their ATR to see if we can find some things that see what that looks like on the other end of fair value. So let's take a look at Merck. Now, I like Merck already because we've seen some evidence of a beginning turnaround in the healthcare stocks, and here's what some of that looks like after a period of just getting annihilated, and it's put in 7 weeks of gains. Now let's take a look at the daily. Nice slow grind, low risk entry here, and you could say if you put your stop at 50 underneath the swing low of the 10, 55 1/4, let's call it, or if you went deeper at 54, or deeper yet at 53 1/2. So we're talking anywhere from $1 to $3 of initial risk, and then with a target of 60, and you could get an entry probably somewhere around 57. So that's a 3 to 1 simply to the test of this long-term fair value, and that looks like a favorable move. So this is, again, almost 4 ATR below its long-term fair value. And let's take a look at Coke. Same thing. It's been stabilized here. I could see rewarding momentum, but this does not look like a symbol that's moving. It's just approaching its 0 line once more. I don't mind this. I wouldn't mind an entry above here. So now it has to break out of that. So I'm looking to enter around 46. Target 47 1/4 with maybe a 50-cent initial risk. McDonald's, same thing. It's still below its 0 line. You can see the magnetic attraction of the 270, pull back, gains, pull back, gains. So this is where that 5DD and buying the mechanical entry above the previous doji gets you an entry around 172-ish. You'd be $3 in hand. With a target of about 178, just if it gets back to the RL270. So you can see how these two regression line fractal framework clusters give you different kinds of life cycles to be trading. In some cases, looking for deep value and turnarounds. In some cases, looking to exploit. These are the turnarounds here. In some cases, being able to exploit longer-term momentum. So take whichever end of that curve you feel more comfortable with. I just want to take a look at CVX in the energy sector. This looks reasonable. I mean, I can see why it has pulled out, but we've had 2 days of pullback, failure to advance further, but also failure to fail. The last time it did that was in here, and there was a bounce. Last time before that was here, and a bounce. Before that it was here, and a bounce. So I think there's more room in the energy sector. Let's keep an eye on Chevron and then XLE. We should be seeing something. So Chevron has already given back a little more. It had 2 days down, whereas the energy sector itself only 1 day down. You see the energy has been riding Z2 for a while now. I'd be concerned here about making sure you lock in the profits of anything that you've gained along the way, because the move back to 70 would not be surprising, because that's simply a reversion to the mean. So if it took time to decay and this kept drifting, you could see really support at 72 looks pretty strong. So this has gotten a bit ahead of itself right now, and I think is perhaps vulnerable. All right, that's everything I want to cover tonight. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.